Okay, so now that we've gone through continuation type entries, we're going to get into reversal model and talk on how we enter liquidity, single confluences, and double confluences. So let's get straight into it. So reversal type entries, put simply, is when price leaves an unmitigated supply demand zone. So in this example below, we are going to be looking at a supply zone. So what we will usually see with a supply zone is a downtrending market where price is putting in lower lows and lower highs, clear downtrend, trading from supply zone to supply zone, and mitigations. But what will happen is price will leave an unmitigated area behind, so a supply zone, which can be traded at a later date in price. This is exactly what the diagram below is showing, as you can see here. So what we had was price putting in lower lows, lower high, lower low, lower high, all the way down. And once we broke this low here, price pulled back, mitigated that area, which is just a diagram, but you get the picture. But if we look at this area here, when price put in a lower low, price came back up to around 50% and then put in a new lower low. So this area here can be classed as our supply zone and an area where price has not come into to mitigate and can be traded at a later date. Okay, so some important tips. What makes this class as a reversal entry is because of bullish structure which is being created coming into that supply zone. Okay, so if this area is going to get mitigated, then price is going to need to be, obviously pushing up, which is going to be breaking structure, as you can see. So we put in a lower low, we then pushed up, broke the most recent lower low, we then come back down, mitigated that newly created demand zone, and then we put in a new higher high, breaking structure, which confirms that to be a higher high and confirms this as the new higher low. So you can see we're now putting in bullish structure, or you could say order flow, to the upside, which can be traded into the unmitigated supply zone. Okay, so another tip, liquidity can also play a huge part and give us that edge for the supply reversal to actually play out in our anticipated direction. It always comes back to the why and where price is likely needing to go to mitigate, collect orders, sweep liquidity before we get involved in the trade. So what we will usually see, as you can see from here, we had a change in momentum, but what you can see is we have liquidity. So we have equal highs, which a lot of traders see this as a double top, but what we see this as is one high, a second high, price pushes off, people are looking to get short from this double top, and especially once price is now pushing down, people are getting FOMO and they want to get involved in the sell. But what we know from looking at price a little bit deeper is a lot of money is going to be above this area, and price is likely to sweep it, tap into the supply zone, and then sell off from here. And once this happens, we usually see a lot of momentum after price comes into that level. The reason why is because price has a reason to move. So price has essentially taken fuel, it's got money behind it, and now we can see smart money get involved and then trade with the large institutions and banks. We also have liquidity that was built from these lows as well. Anyone looking who got in long from here, as they're seeing, breaks the structure, and this is intent for higher prices because price failed to put in a new lower low, then we broke structure. Okay, but this is still liquidity from people who are long in here, which is another reason or another confluence for us to target, and essentially it gives the reversal supply zone more reason to play out in our favor. Okay. Now what we can do now is look at the lower time frame entry types. So let's get into that now. So once price comes in, takes liquidity, we want to be looking at entries. Now it is the same thing as our continuation entries, where we still want to be waiting for, you know, lower time frame confirmation, because price does not need to go short from here. It's likely, but it's not 100%. We need to trade the lower time frames, and as I always say, trade the momentum and wait for confluence and confirmation. Okay, so that's how we do this, as you can see here. So this move coming up into the supply is always going to be giving us higher highs and higher lows on, you know, a lower time frame down from the hourly, whether that be the 15, 5, 3 minute, 1 minute, and whatever time frame you're executing on, you know, you're going to see higher highs and higher lows coming in. Okay, so this is what we got here: higher high, higher low, higher high, higher low. We want to simply wait for a breaker structure, as you can see, and we want to wait for the most recent higher low to be taken out. Now, as you know, I always wait for, you know, clear momentum. If this move here breaks structure but is seeking liquidity from, say, an unmitigated demand zone, exactly the same thing as we have here in reverse. If we don't get that momentum break and it taps into, you know, I'll just draw it out for you, and say it taps into an unmitigated 1 minute time frame demand zone, takes liquidity from them lows there, taps in, then it could go long. Then I would be looking to take that long. But that's the reason why I'm always looking for this to break with momentum, and then, you know, look for my clear area. What calls the break? What candle calls the break? Is there a range? Is there a clear range we can take, or is it one candle? You know, we look at price and then we can make our decision based on that. Okay, so this would be a single boss. So this is the lower time frame single boss, which is break of structure from higher time frame supply zone, which is this. Higher time frame unmitigated supply zone, lower time frame break of structure, single boss, which is a single confluence from reversal area. If we want to see a tap into that area, then we can be looking at this as our entry, and something like this. And then we're looking to target, we don't want to be targeting, you know, the 1 minute lows, because that's just holding us back. We want to be targeting, you know, the higher time frame liquidity and the higher time frame sort of, you know, swing points and previous lows. Okay, that is how we get the most out of the trade, because you need to think, we've taken liquidity from here. It's really, you know, there's a very high probability that price is going to put in a new lower low, because there's fuel behind the move. Okay, so double confluence from reversal area, as I'm sure you can see, same thing, but it's just, as it says, it's a double rather than a single. Okay, so it's the same thing, higher highs and higher lows coming into the level, and a single boss would be one break of structure. As you can see, we had a single break here, price came in to mitigate, then we broke structure again. Now, one question I'm guessing you're probably thinking, does this single break need to mitigate? Let me just move that out of the way. What if it only came back to here? And is it still considered a double break from here? So let's just say price, it came back into there and we see it go short from there. Is that valid? Yes, it's definitely valid. I always say to adapt with the market and, you know, look at the most freshest sort of breaks to structure. This first break here does not need to, it does not need to come back in to mitigate. But if it does, you know, it's better. but it's not needed, because once we break once, price can push back up and refill any imbalance, or even just pull back slightly, then break structure again. I'm sure you've seen it quite a few times. But when that happens, we can just take that most recent break of structure, or what you can do is go and back test it and see what works best for you. But for me, I'm always taking the most recent break of structure and looking to adapt with the market and go from there, really. So now we've gone through that, what I want to just do quickly is show an example on the actual live charts. As you can see here, I think this is a pretty good example of the reversal model. Okay, so let's get into it. So we're on Euro USD hourly time frame. As I was saying previously, what we have is a clear downtrend where we're breaking structure, so I can draw it on. So we had a break of structure here. So price broke the most recent higher low. We didn't come back into this last up close candle. So this is left unmitigated, which could be used for a later date, who knows. But rather than waiting for this, we can adapt with this break of structure here. We had a tap in, mitigation, continuation, break of structure here, last up close candle, most recent lower high, mitigation, and this was a trade we took, which ended in like 30% or 25%. Okay, we have the next break of structure, which is this candle, which broke that low. But then we pulled back and broke again. Last up close, refined to that candle, mitigation. So I'm sure you get the idea. Now, what we can look at here is that as the most recent lower low. As you can see, we mitigated in, had a little bit of range. All of these breaks within here is substructure breaks within the sort of the swing point, which is here, lower low, and really up here is the lower high with a little pullback there, but that's really the swing point. Okay, and then this move is the move that broke and then put in the new lower low, which you can say it's definitely got some momentum behind it, and this is efficient pricing, but it's definitely an area where we can look at as a supply zone. We have a clear range and then initiation out. Now, a key point to just cover quickly, we do have a tap in here, but as I've always said in recent videos, that the 50% of an order block or supply zone is what I look at to class something as mitigated or not. Now you can see price wicked in, but it didn't mitigate to the 50%. We can still trade this, which we did trade, and we took some great percentage, but this area is not voided and we can still trade it at a later date. Okay, so let me just bring that to the front. Okay, so although we took trades within there, we have opportunity, I should say, to trade it again as price came in, as you can see. So you can see price came in perfectly to the to the pip, and then we see large momentum down, which then put in a new lower low. Okay, so why has this happened? Well, firstly, we tapped in, but we didn't fully mitigate. We put in a new lower low, and as I was saying, that price will break bullish structure coming into the unmitigated supply zone. Okay, so you can see that's exactly what we have. A bit, this was NFP, I believe, or news, but what you can see is we broke structure. So we broke the most recent lower high, wicked it, but we're looking at just structure overall. We then have the same thing here. We break again. So we're putting in higher highs and higher lows. Same thing, we break again, higher high, higher low, and we can trade these. We can trade long into the supply zone, which I was looking at this, if I can remember, but we just fell short. We came into rebalance, some inefficient pricing, but we didn't quite come into this last down close order block. Okay. Now this is what I was saying about bullish structure being formed coming into these areas. Okay, and again, we put in another break of structure, which is gone on that. Break of structure, there we go. And then we tap into the supply zone, as you can see. So yeah, we can trade these. We have a break of structure here, a tap into that last down close candle or this wick, which we can trade long. And if I just remove this for a second, what we can also see is, although it's not perfect, we have equal highs. But as I've always said, equal highs does not need to be perfect. This is still definitely considered liquidity point and where people are looking to sell from. Because if you look at this, we have a high price push down, come back up, sort of giving a sort of U shape, double top area, retrace candle. We get some sort of rejection from that area. Retail are looking to trade. They're looking to get involved. A lot of traders be sizing this up, 15 pip, even 20 pip stop loss, because there's no clarity. They need 20 pips and taken out. But we know this as a clear area where price is likely needing to go to collect orders, stop losses, you name it, and then we're getting involved from here. Now that is the exact reason why we see price then tap in, mitigate, and look at the momentum, which is bigger than all of this move here, these two candles. Okay, because it's fuel. The market has now got fuel and it can move to the downside. We break structure and then targeting at a minimum the hourly low, and you can see we just go below it and then we see a reaction and we break again. And these are trades that we take, and this is what we can get involved in 2, 3, 1 pip stop loss, and then we're looking at 30% just to the low. Okay, so it's all about understanding the why and where's liquidity and where's price likely to go to.